Are you saying?
Income tax, computation, and education tax.
Okay, thank you. Thank you so much. Yeah, so good evening once again. My name is Idris Oladimeji Balogun, and as I've been rightly introduced, yeah, I'm a senior tax consultant. Yeah, so I'll be walking us through the concepts of corporate income tax in Nigeria, what a typical taxpayer, corporate organizations need to know, the fact that we are also in the season of filing, and you can see that FIS are even taking this thing very serious. They've been circular and notice that FIS, they want to work, over the weekend, Saturday and Sunday, just to make sure that we all fulfill the part, the part of our own, our job. So, not to waste much of our time, you agree with me that corporate income tax, right? It is it is a statutory tax paid by corporate organizations. And when we talk about corporate organizations, we're talking about companies that are incorporated under the Companies and Allied Matter Act with the CSA. So in the course of this class, we look forward to learn the some basic things there, which includes introduction to CIT, chargeable and exempt income and profit, your definition of your wholly, exclusively, necessarily, and reasonably test, and how it relates to CIT, your liable and disallowable expenses, examination of your accessible profit and total profit, then other statutory levies that we have, levies like your NITIDA, your NASENI, and police trust fund. Then we have major pitfalls in CIT. Yeah, there are some major, issues, major adjustments that most taxpayers, they tend not to really understand the appropriate treatment of all of these transactions. And yeah, we're going to demystify all of this. Yeah, so then we will proceed to the questions. Now, during the course of this training, I might bring in some other stuff that are not in this table of contents. Please allow me. Yeah. So we have the introduction. So CIT, also known as what we call the corporate or the company's income tax, and the tax that is charged on the profit of an incorporated entity, a company here in Nigeria. Now, so what are the statutory framework that that underline, that underpins the concept of CIT? So we have the the principal legislation itself, which is the Companies Income Tax Act, Capsit 21 2004 as amended. We have the Education Tax Act. We have the Police Trust Fund Act. We have the National Information Technology Development Agency, which is in NITIDA. We have the NASENI, that is the National Agency for Science and Engineering Infrastructure Act. We have the FRS Establishment Act, right? Then we have various official gazettes, finance acts, and circulars issued by the FIRS. So, like I've said, at what point can a company be liable to companies income tax in Nigeria? Yeah, every entity, every corporate body that is established under the CAMA by the CAC are expected by the virtue of the law to register with the FIRS and file their company's income tax returns as and when due. So when we get to the part where when you're expected to file your CIT return, we'll talk about it. Yeah. So for a Nigerian company, you are automatically liable, obligated to file your income tax return with the FIRS, with your respective, through the self-assessment and your respective tax offices. Also, we have companies that are not registered, they are not incorporated companies here in Nigeria. They are recognized as what we call non-resident, and they do business here in Nigeria. Yes, they are also captured under the provision of the Companies Income Tax Act, which is the popular section 13 of the CIT, right? Talks about the Nigerian company and companies other than Nigerian company. So for Nigerian companies, like we've said, the global income, the worldwide income will be taxable here in Nigeria. So for a company established here solely here in Nigeria, and the company has other income from overseas, the CIT, right, provides that the income brought into Nigeria, earned in Nigeria, received in Nigeria, will be taxed here in Nigeria. So it means that as a Nigerian entity, your global or your worldwide income is liable to income tax here in Nigeria. Now, what happens to companies that are not incorporated in Nigeria? we refer to them as a foreign company or non-resident company. Particularly, Section 13, Section 2 of the Companies Income Tax Act provides that companies other than Nigerian companies can have taxable presence here in Nigeria if they have what we call a fixed base. Now, when we are referring to CIT or income tax presence of a non-resident company, we refer to fixed base. But when we are now bringing in the double tax treaty, right, that is when we bring in the argument of permanent establishment. So from the view, from the lens of CIT, not the DTT, right, before you can be liable to income tax in Nigeria as a foreign company, you must have a fixed base. And by fixed base, it means that you have a physical structure, you have a place of management here in Nigeria, right? That is, what fixed base means, which exclude, a place where where you store for storage and collection of information. So if we have a foreign company here in Nigeria that is solely for collecting, gathering information, such an entity is not liable to income tax here in Nigeria, provided that it is not doing business here in Nigeria, right? And other conditions that the same section has provided also states that for foreign companies without fixed base, but carry out business in Nigeria through a dependent agent or through their subsidiary related parties, it is possible that they might be liable to from the subsidiary or branch or related party here in Nigeria or through a dependent agent. I will give you a scenario. There are gadgets, right? Electronics and phones. Now, you cannot get the Samsung on iPhone office here in Nigeria. They do not have an outlet, a physical outlet here in Nigeria. What you can only do is that you can only visit, outlets like 3C Hubs, Slot, and the likes to get your iPhones. Now, the activity of those particular entities do not create a taxable presence for iPhone and Samsung in Nigeria, because those companies here, the 3C Hub and Slot, they are acting as an independent agent. It operates through a dependent agent. Now, I see that is not enough, right? The same section provides that when a foreign company engages in what we call single contracts or a turnkey project here in Nigeria, you may be liable to income tax here in Nigeria. The question is that what is a single contract? A single contract is a contract whereby the installation, the delivery, the design, and the construction is being carried out by one particular foreign entity. So when it comes to contract structuring, there are ways whereby a contract can be structured that might not create a fixed base for the foreign entity here in Nigeria. Okay, then the SEP order 2020 came in. That was significant economic presence, which says that you don't have to be in Nigeria physically before you can be liable to income tax here in Nigeria. So if you operate or make money in Nigeria through digital platforms, right, you may be liable to companies income tax in Nigeria through the SEP. So you might have a digital presence here in Nigeria, I might be liable. But the SEP order 2020, provide two different type of activities that a foreign company can engage in that may create, a taxable presence, which includes running of digital services and the technical consultancy, management and professional services, to Nigerian customers. Now, if you are captured under all of these I've mentioned, you are expected to register with the FIRS and compute and pay your income tax liability as and when due. Now, The provision of the company's income tax, gave three categories of corporate entities in Nigeria. We have the small size companies, we have the medium companies, and we have the large size companies. All of these might change the moment the proposed tax bill comes into effect. We won't be having medium companies anymore. We are going to be having only small and large companies. And how has the company's income tax defined small size companies? It says that small companies are companies whose gross turnover is 25 million naira and below. So you have to be careful. It is not below 25 naira, it is 25 naira and below, right? This is well defined under section 105 of the CETA interpretation. And these particular companies, their profits are exempted from income tax. Now, you will see that I put the income tax rate to 0%. Yeah, this is what many of us know, or this is what many of us believe it to be. But no, based on the provision of the company's income tax, small companies' profits are exempted from income tax. Particularly, Section 23 of the Companies Income Tax Act gave that provision, that the profit of a small company, right, is what? Exempted from income tax. So it means that not that they are not taxable. Yeah, they are taxable. You are expected to file your income tax returns, but your profit is exempted from income tax, where you are a small company. Then we have the medium-sized companies. These are companies whose gross turnover is above 25 million naira but below 100 million naira. So when your gross turnover is above 25 million naira and it is below 100 million naira, your income tax rate is simply 20%. Then, as a large size company, when your gross turnover is 100 million naira above, that is, you are neither a small company nor a medium company, then you are a large size company. For that reason, your income tax rate will be 30%. I don't know if you are following.
Yes, we are following.
Good, thank you. So that is for the categories of companies as given by the Companies Income Tax Act. Then we talk about the chargeable income and income that are exempted from CIT. Now, before we delve deep into this particular area, I need to walk us through the obligation of corporate entities as regard the filing of income tax returns. When are you expected to file your income tax return? As a new business that has just been incorporated in Nigeria, or as a business, as a foreign entity that is just doing business here in Nigeria, you are expected to file your first income tax return at the earlier of 18 months from the date of incorporation, or 6 months from the first accounting year end. I'll take it again. For a new company, for a new entity as just established here in Nigeria, with taxable presence here in Nigeria, you are expected to file your first income tax return at the earlier of 18 months from date of incorporation, or 6 months from your first accounting year end. So whichever is earlier is when you're supposed to file your income tax return. And you should know that company's income tax is filed on a preceding year basis. The meaning is that the profit of 2024 will be assessed to tax in 2025 year of assessment, excluding companies that operate in the oil and gas upstream sector. For companies in the oil and gas upstream sector, they are expected to file their CIT return in line with the provision of the Petroleum Industry Act. So for upstream company, they are assessed on actual year basis. But for every other company other than the upstream company, you are assessed on the preceding year basis. So which means that the profit of last year will be assessed in the following year. So for an existing company, you are expected to file your income tax return at on or before 6 months from your last accounting year end. So it means that for companies whose accounting year end is December annually, they are expected to file their income tax return on or before June 2025, which is this month. The question now is, what happens if I fail to file by June 2025 for companies whose year end is December 31st? The law says that failure to file your income tax return will give rise to a penalty of 25,000 naira in the month of failure and fine that the penalty for not filing your income tax return is 25,000 naira in the month of failure and 5,000 naira every month until the failure ceases. But that is not all. If you now end up filing your income tax return and there is income tax liability for you to pay, then the law says that there will be penalty and interest for non-remittance of your income tax liability, and penalty will be assessed at 10% of the principal amount of income tax liability payable plus interest at the CBN monetary policy rate plus spread. Typically, practically, the spread used to be 5%. So the interest will accrue every day, and the penalty is just 10% of the principal amount you fail to pay. Now imagine a company with annual income tax liability of 5 billion naira, and you failed to file your income tax return as and when due. It means that apart from the penalty for non-filing, you will be exposing your company to avoidable penalty and interest. 10% of 5 billion is grossing up to about 500 million naira. That is different from the principal amount of liability you are expected to pay. So you have to be on top of your game. You have to be time conscious. You have to make sure that you do not foul the law, because there is no ignorance in law. There's no ignorance there. Tax formers will not know whether you were sick or anything. Automatically, the tax former will compute your penalty and interest immediately. It is after 12 a.m. 1st of July 2025. You already see the penalty on your tax former's account. So that explains the obligations of taxpayers on when and how to file their income tax returns. So what are the incomes that are chargeable to CIT, and what are the profits that are exempted from CIT? Section 9 of the CIT Act gave us the list of income that are chargeable, so which includes income from any trade or business, rent or any premium arising from rights granted, dividend, interest, royalties, any source of annual profits or gain, fees, dues, and what have you. Then also what we call profit exempted. These are profits that are not liable to income tax. They are exempted. They are not taxable. That does not mean that the particular company is not taxable or is not liable to CIT, but the profit is only exempted. That means for any entity that is under this exempted list here, that does not mean that you are not to file your income tax. You have to comply with section 55 of CETA. You are expected to file your income tax return, but just that your profits earned from these activities will be exempted from income tax. So example of this profit includes the profit of registered friendly society, cooperative society. We have the charitable, ecclesiastical, educational institutions. We have the sports promotion companies. We have trade union, companies established by local government. We have the companies established by a state for purpose of fostering economic development. This one has to do with companies that are enjoying pioneer status, right? And other companies established by state. We have the small companies as well. Their profit is exempted from income tax. We have dividend, interest, rent derived by a company outside Nigeria brought into Nigeria through the government approved channel, which is the CBN. Then we also have interest on deposit accounts of a foreign non-resident account company, interest on foreign currency domiciliary account, dividend received from investment in export-oriented business, income earned from investment in federal government bond, capital gain on disposal of asset, etc. So the list is actually inexhaustive there. So check up section 23 of CETA, you definitely get to what? To see profit that are exempted from income tax. Then we move down to the WREN test. This particular test is what we use to identify if an expenses is meant to be allowed or not. So the deductibility of an expense depends on the WREN test, and the WREN test talks about wholly, reasonably, exclusively, or reasonably. Now, if the proposed tax bill is passed, the necessarily and reasonably has been eliminated from the Nigerian tax bill. So on the tax bill, we only have wholly and exclusively. But within the context of this training and what companies need to file their income tax return for June, you are still guided by the WREN test. So only means that the expenses or the cost is completely and entirely incurred for the production of the taxable income. Why necessarily? The word necessarily means it is solely. It means that if we don't incur these expenses, will the company make this or not make this particular amount of taxable income? That is what necessarily means. So this is still subjective. It's subjective to the interpretation of the FIRS. They also have reasonably and exclusively. So we talk about the allowable and disallowable expenses. So based on section 24 of the CETA, the following expenses are allowable: interest paid on money borrowed for the business, rent and premium, salaries and wages and other staff costs, repairs expenses on fixed assets, repairs, renewal, alteration of utensils, bad debts incurred. If you can prove that the bad debt has been incurred, yeah, it is allowed. Not all bad debts are to be disallowed. We have the specific provision for bad or doubtful debt should be allowed. We have the pension. When you make pension contribution to the statutory, to the appropriate pension administrators, we have the research and development expenses. Also for the allowable expenses, we have capital expenses, capital losses, any penalties prescribed by any act of National Assembly. We have depreciation. Now, depreciation. Now, when it comes to amortization, we're going to talk about it. Amortization, on a good side, should not be disallowed. Should not be disallowed. I'm going to give you guys my reason. Then we have impairment. We have general provision. We have expenses incurred in deriving your tax. So any expenses that you've incurred in deriving the tax exempt income are to be disallowed. Are to be disallowed because the income is not taxable. Then the expense would definitely not be allowed for deduction. We have taxes on income or profit. So the list is inexhaustive as well. We have donation that is not made to the appropriate body based on the 5th schedule of CETA. Yes. So then after understanding all of these allowable and disallowable expenses, then we have the template of your income tax. Now, so before I move to the template of the income tax, now why is amortization not disallowed? If you understand the concept behind disallowing depreciation, you agree with me that you are not to disallow amortization. Yes, because depreciation is disallowed because capital allowance is given in place of it. And if you check the 2nd schedule of the company's income tax on capital allowance, you hardly get to see any capital allowance rates for intangible assets, because amortization is what has to do with intangible assets. It is the systematic allocation of your depreciable value of an intangible asset over a useful period. So a company has equally incurred, cost on intangible assets, and they've responsibly amortized it over the useful life of the intangible assets. You can't tell me I'm not going to allow the expenses. Then how will I claim the cost and the company has incurred? Are you clear on me now? So you can always argue that amortization is an allowable expenses, unlike DEP that has replacement, which is capital allowance. Impairment as well is also it's allowable expenses. I don't know if you are with me.
Yes, we are still with you.
Okay, thank you. Yeah, so now we move down into the income tax template. So how are you supposed to compute your income tax liability? Now, this depends on your tax consultant, depends on the company, income tax template, right? But this is a basic, outline of how to arrive at your income tax liability. Now, there are two methods. We have the direct method and the indirect method. In most cases, if you are computing your income tax liability, we do employ the indirect method, which is what we are seeing here. But when you are filing on your tax pro max, it is simply, you have to now populate more like the direct method. Populate your revenue, other income, your expenses. Then you now have to take out the disallowed and allowable ones there. So before you file your self-assessment on tax pro max, you ordinarily should have computed your own income tax liability, right? So which might be based on this template or any other template you have, but you have to make sure that you are allowing the correct expenses, and you are also allowing the correct taxable income. So under the indirect method, you start with your profit before tax, you add back the allowable expenses, so which includes depreciation, bad debt. Now this bad debt here depends, right? So some companies, they might be unable to substantiate their bad debt. So as a tax consultant, when your client is unable to substantiate its bad debt, there is no, for example, you have a parent giving loan or getting something, selling to a subsidiary, and the subsidiary is not having a bad debt, or the parent having a bad debt in their book, bad debt from a related party. How can you convince me that you've tried all the possible means to get the debt from your brother or your mother? You guys are family, so how come the debt can become a bad one? So you have to provide, convincingly how the debts, become bad. So we also have fines and penalties. You have impairment. You have the donations that are not listed in the fifth schedule. You have the expenses incurred in deriving non-taxable income. We have unrealized exchange loss. Then, so among other items too, they will be added back to your profit before tax. Then you less your tax exempt income, which includes dividend income, gain on disposal of assets, because there will definitely be balancing charge that will replace your gain on disposal of assets. We have unrealized exchange gain. Yes, it is not realized yet, then it can't be taxable. We have your total non-taxable income as well. After you've less your tax exempt income from your profit before tax, you arrive at what we call assessable profit. Now, many of us, especially for those of us, who learned one or two things during our ICANN stage, we used to call this guy here taxable adjusted profit. Please, the CITA never made any provision about adjusted profit. Under CITA, you only have assessable profit and total profit or taxable profit. It is only in PIA that you have adjusted profit, assessable profit, and taxable profit or chargeable profit. But under the company's income tax, we have what we call assessable profit. and total profit or taxable profit. So what you used to call your adjusted profit is same thing as our stable profit. Then after which you add your balancing charge to it, you also claim your loss relief, if any. Then you have your capital allowance. Now, at the point where you are claiming your capital allowance, for companies that are into agro-allied, midstream gas operation, these companies, they do not restrict their capital allowance. They claim full capital allowance. Companies that operate agro-allied industry and companies that operate in the midstream gas operation, they don't restrict their capital allowance. They claim their full capital allowance. Why every other company, other than the ones I've mentioned, they restrict capital allowance to 2/3 of their assessable profit. Now, I have seen a case scenario where the tax promise erroneously compute the 2/3 on the assessable profit after claiming loss relief. Yes, I've witnessed such an error from the tax promise where the tax promise erroneously computes the 2/3, that restriction, on the assessable profit after claiming loss relief, which is wrong. Because the second schedule of the SITA clearly provides that you are to restrict 2/3 of assessable profit. And the provision of the Corporate Income Tax as defined assessable profit to be the profit after adjusting for your expenses and income. So your 2/3 is expected to be calculated on the assessable profit, not after claiming your loss relief. So after you claim your capital allowance, then you have what we call your total profit or your taxable profit, on which you slam your income tax rate on. Depends if you are a medium or you are a large size company. So a medium company tax rate is 30% and large is medium is 20 and large is 30. Now, at what point will a small company exempt its profit from income tax? Now, at the point where you have your total profit, if you are a small company, you just come under this total profit and write profit exempted, section 23 of SITA. So the exact amount of total profit you have is what you put there under the profit exempted. Because as a small company, you will still claim your capital allowance. The only company that is not allowed to claim capital allowance while computing is company that is enjoying pioneer status. Because during your pioneer status, all the QC acquired during those periods will be deemed to have been acquired at the new trade, which is the day following the what? Your old trade. So the only company that is not allowed to claim capital allowance is the company that is enjoying pioneer status, while every other company will still claim their capital allowance. Then you calculate your tertiary exemption tax at 3% on your assessable profit. So we have, when you are not filing your income tax returns, what are the required documents you need to file your self-assessment on tax promax? You need to have made your own computation already to know the possible income tax liability. You need your signed financial statement. Because by the time you are done filing your income tax return on the tax promax, you will be asked to upload your signed FS. Draft is not allowed. Then you also need to complete your capital allowance schedule to know the amount of capital allowance to claim and the one to carry forward, right? But while you are filing your self-assessment on the tax promax, you need your signed financial statement and you need your income tax computation so as to compare it with what tax promise has computed for you. So in case there is any error, you don't proceed to pay. So your self-assessment is guided under section 55 of CITA. Now, what are the major pitfalls in CIT? These pitfalls here are where some tax consultants, some taxpayers, they get not to give you the appropriate treatment, whereby they end up paying unnecessary taxes to the government. So one of the major pitfalls in CIT include the treatment of your right of use. Now, the moment you observe that a company has leased property in their financial statements, in their SOFP, they have a leased property, definitely there might be right of use. And when there's right of use, the company might want to depreciate the right of use, which obviously, based on IFRS 16, you are expected to depreciate it, to depreciate your right of use, right? Now, if you are conversant with IFRS 16, there is depreciation on right of use, and there is interest expense on your lease liability. Now, and the lessee will also make lease payment, rental payment annually. It's possible the payment is made lump sum in advance, or they make the payment annually. Now, when it comes to your income tax computation, the law provides that any depreciation of ROU is to be disallowed. The interest on your lease liability as well is to be disallowed. Then you create another row for the actual rent amount paid. So the actual amount that will be allowed for deduction in relation to this lease property will only be the actual rental amount paid, because the interest expense on lease liability is a notional interest, same as the depreciation. So the real expense, the cash expense that is incurred on the lease is the actual lease rental paid, which is only the asset, which is only the item that will be allowed for deduction. So in case you observe that a company has lease property in their asset, look out for your depreciation on ROU and interest on lease liability. Both of them are to be disallowed. Then you bring in, your actual rental amount paid. You bring it in and allow it. I don't know if I'm making sense.
Yes, you are making sense. Thank you.
Yeah, thank you. Now, the next is treatment of exchange differences. Many of us might really not understand the difference between unrealized exchange difference and realized exchange difference. And at what point am I expected to tax this exchange difference or disallow it? According to IS 21, exchange difference may arise as a result of translation or conversion. And IS 21 provides that exchange difference coming from translation should hit your OCI, your other comprehensive income, because what you're only doing is that you are only translating the account of a subsidiary into the currency of the what? Of the parent. So any exchange difference you have, you get from there, it is simply unrealized and it goes to your OCI. And OCI will never affect your profits for the year. But any exchange difference arising from conversion of either your monetary item or non-monetary item, majorly monetary item, goes to your P&L account. Now, if the debtor is yet to settle its liability and you have an exchange difference from that transaction, if it is an exchange gain, it is unrealized until the debtor settles is or are liability before any exchange difference will become realized. So at the point when the debt has not been settled, any exchange gain or loss from it should be treated as unrealized. And unrealized exchange difference would definitely lead to affect your deferred tax computation, which could be your deferred tax asset or liability. So unrealized exchange gain should be deducted as non-taxable income, while unrealized exchange loss should be treated as what? Disallowable expenses, and will definitely affect your deferred tax computation. That's the treatment of exchange differences. The next one is what we call the interest deductibility rule. Section 11, by extension, the 7th schedule of the Companies Income Tax Act provides that when a company has foreign loan, foreign finances from related party, the interest deductible in a year of assessment will be subjected to what we call the interest deductibility rule, which says that when a company has foreign related loan or debt or finances, the amount of interest deductible in a particular year of assessment will be restricted to the lower of 30% of your EBITDA and the total allowable interest expense. So it means that whenever you are computing your income and liability for a company, you have to check whether the company has a foreign loan from related parties. If this exists, then you are going to subject the interest to what we call the interest deductibility rule, which says that the interest that will be deducted will be restricted to 30% of your EBITDA, and EBITDA is earnings before interest, tax, division, and amortization. Are you with me? So the law also provides that any interest that is not claimed, deducted in a year of assessment, can only be carried forward for a period of 5 years after from the year of assessment you have claimed it. So if in a particular year of assessment you have restricted your interest to 30% of EBITDA, that means the remaining excess interest cost that is not claimed for that year of assessment can only be carried forward for a period of 5 years, after which it cannot be claimed anymore. 7th schedule now further provided that some companies are exempted from this rule, which includes banks. Banks are exempted from the interest deductibility rule. They are not liable to it. They claim their interest expense. Then we move down to minimum tax computation. Section 33 of CETA provides that a company is entitled to pay minimum tax when the income tax liability is lower than the minimum tax, and the minimum tax is simply 0.5% of gross turnover less frank investment. So it means that if dividend or frank investment has been part of your gross turnover, you are going to less it. So minimum tax is computed by applying 0.5% on your gross turnover after removing your frank investment. However, some companies are exempted from minimum tax, which includes small companies. Small companies are exempted from minimum tax. Companies within the first 4 years of commencement are not liable to minimum tax. companies into agriculture is not liable to minimum tax. This amendment was introduced by Finance Act 2019. So there are 3 companies that are not liable to minimum tax: small companies, companies within the first 4 years of commencement, and